Let's get this party started. Let's quantify risk, how we quantify or measure risk. Slides 41 through 49. Let's measure risk, all right? So, what is risk in finance or investments terms? Risk is uncertainty that an investment will actually earn an expected rate of return. So you forecast your rate of return, your required rate of return, then you buy that investment, and then you compare your actual rate of return with your forecast rate of return to see if they're close. And you know there's going to be uncertainty. Okay? Investment risk is quantified, it can be quantified as the volatility of an asset's price or return. The movement. How much does that price or return bounce around on a periodic basis? By hour, by day, by week, by month, by quarter, by year. How volatile is the asset price, the stock price, or the return? Okay? So let's calculate an expected rate of return. It is an estimate or a forecast of the most likely return from an investment. So this is all theory. Okay? Make sure. Okay. Now let's look at risk aversion, the concept of risk aversion. Risk aversion means investors must receive additional return in order to assume additional risk. Listen, folks, this is the foundation of capitalism. Okay? The relationship between risk and return. The only reason you take more risk is to earn a higher rate of return, and you must assume that if an investment is going to provide a high rate of return, that there will be a high degree of uncertainty and volatility involved. Okay? You don't go out seeking risk. You go out seeking return. Okay? So you don't look at this relationship between risk and return and say, okay, I'm going to go seek risk. No. You go seeking return, knowing that the higher the return you think you're going to make, the higher the risk that's involved. Therefore, when someone says, this is a slam dunk, this is an excellent investment that's going to generate a high rate of return with a very low risk, somebody is underestimating the amount of risk involved. Okay? So, if expected return is the same between two investments, according to the theory of risk aversion, you choose the investment that has the lower risk. If the expected return is the same, go with the investment that has the lower uncertainty. Okay? And this is the basic risk-return trade-off. We talked about this a lot in ManFit. All right, so let's look at how we can quantify or measure risk. Okay, variance, the statistics of variance and standard deviation. You learned them in Math 200. Okay? These are statistics that measure the average difference between individual outcomes and the average of individual outcomes. So we're going to take a look at how to do these calculations, and you'll see what I'm talking about. And this is volatility. How outcomes, when you take observations. What was the price today, day before, day before, day before, day before. Compute a return for each day, and how does that return bounce around? That's volatility, and we'll compute an average and then the average difference. All right. And so in the investment business, volatility or price movement is risk. All right? And please note that you can use the expected return and the standard deviation, okay, with a normal distribution table to determine the probability of an outcome. So now we're going to use statistics to help us understand, make an informed decision. Make an informed decision. All right. So it's important to consider at least two dimensions of return. Okay, so we're going to measure return in two ways. One dimension is called an absolute return. And these are terms that are important to investors and to people in the investment business. An absolute return. Okay? This is the return that is actually earned. Okay? For example, you earn a return of 15%. Okay? That's your absolute return. Another way to express a return is to compare the return you earn to the return of a similar investment. Now we're trying to create context for that 15% return. So we buy a stock and we earn 15%. And we actually don't know if that's good or not. Now I will tell you this, if our expected return was 15% and we earned 15%, or if our expected return was less than 15% and we earned 15%, then we're happy with it. Okay? But we're trying to create context. How well could we have done in other similar investments? And this is called a relative return. So we have an absolute return, that's the 15%. Now we have a relative return. How did our actual return compare with the returns from similar investments? Okay? A common example of a relative return is to compare the return of a stock or of a portfolio with that of the overall market. So you hire me, I manage your portfolio, I tell you your portfolio earned 15% this year. Okay? One of your first questions needs to be, well, how did the market do this year? Well, the market was up 13%. So now you're feeling really good. But then the question becomes, how much extra risk did you take with my portfolio to earn that 15%, that extra 2% of return? Now, if I show you that I took the same risk as the market, or less, but I earned a higher rate of return, then I delivered something for you that's very rare, and that's called alpha. Alpha means that you earned a superior risk-adjusted return. And alpha is what all investors want to earn, but very few investors actually do. All right, so the relative return creates context, which helps establish a more accurate assessment of the return. Okay, it's important to note that absolute return does not take risk into consideration. It's just a number, 15%. There are several ways to combine return and risk to get what is called a risk-adjusted return. So we have absolute return, we have a relative return, and now we're going to look at a risk-adjusted return. We are adding more and more information to the equation so we can better understand and assess how our investments are doing. All right, coefficient of variability, the CV, coefficient of variability. This allows you to compare two investments with different expected returns and different standard deviations. So you're looking at two different investments, and they each have their unique expected return and their standard deviations, their volatility. Okay? So let's compare them to get a risk-adjusted return. Which investment did better? Okay? All right. So what we do is we divide the standard deviation by the expected return. And we get risk per unit of return. All right, let's look at an example. This is simple math, don't freak out. All right, so stock A has an expected return of 15% and a standard deviation of 10%. So the coefficient of variability, my lines are off a little bit here, is 0.667. Let's look at stock B. Our expected return is 12% and our standard deviation is 5%. So if you look just at expected return, you're saying, I'm going with this one. Okay? 15% versus 12%. But then when you throw risk into it, let's look at the risk per unit of return, and the risk per unit of return is much lower for stock B. So when you start comparing the returns and the risk, stock B on a risk-adjusted basis is the superior investment. Now, once you see that as an individual, that doesn't mean you must buy stock B. you might want that 15% expected return. That 12% might not be enough for you. You may need that absolute return of 15%, and if you do, you might be willing to take on that additional risk. So I'm not telling you you must buy stock B. I'm telling you that the relationship between return and risk is better for stock B than it is for stock A. You're making an informed decision. Each individual has to decide which investment is right for their circumstances, okay, for their needs. Okay? You might be under the gun. You might not have invested enough or wisely and saved enough, and you might have to earn that 15% rate of return to get your target dollar amount. So stock B might not be the stock that you want. All right. Risk-averse investors who understand the relationship between risk and return will use this to determine if the risk premium is sufficient to justify an investment. Okay? All right. The Sharpe ratio, another way to calculate a risk-adjusted rate of return. So it measures the excess return compared to the risk taken. So we're going to put return in the numerator. So let's take actual return that you earn on the stock minus the risk-free rate, and that's called the excess return. And now we're going to divide that by the standard deviation. Okay? So here's an example. Once again, yes, you'll be tested on this, but I'll give you all the information you need. It's a simple equation. You can do this. Okay? Okay, portfolio A has a return of 15%. That's your absolute return. And a standard deviation of 11%. Portfolio B has a return of 12%. So if you're just looking at it, you're going, wow, this manager didn't do very well. Well, let's look at the standard deviation of 8%. So this one was a higher risk, higher return portfolio than this one. Okay? And you have to decide on the front end how much risk you're willing to take. You don't get angry on the back end if you take less risk and earn a lower return. Okay? Don't blame your investment manager if that happens. You have to make an informed decision on the front end. All right. The one-year Treasury yield is 2%. That's your risk-free rate of return. Okay? So portfolio A has a Sharpe ratio of 1.18, and portfolio B has a Sharpe ratio of 1.25. And so what this means is that the relationship between return and risk was better in portfolio B than in portfolio A. Okay? Now, if you were shooting for that 15% rate of return and you got a 12% rate of return, you're not going to be happy. In other words, if a manager says, well, I only had 8% volatility and your other manager had 11% volatility, you might say, yeah, but I told you I wanted to take more risk, and you didn't do it. Therefore, you earned a lower rate of return, and I'm not happy about that. So you have to be on the same page with your managers. But I will tell you this, on a risk-adjusted basis, portfolio B did better than portfolio A. Okay? So once again, it's about making an informed decision. Okay? You get more return per unit of risk taken with portfolio B. Okay, the general rule between risk and return, we talked about this in ManFin. The most fundamental relationship in investments and in capitalism is that of return and risk. Generally, the riskier an investment is, the higher the expected return must be in order to justify taking that risk. Okay? And to generate a high expected return, investors usually have to take more risk. Again, be careful of the salesman who tells you this is a slam dunk. Okay, the promoter who tells you this is a slam dunk, it's going to be a great investment, high rate of return, and virtually no risk. Okay, they're either lying to you outright, or they're, as George W. used to say, they're misunderestimating the risk involved. All right. This does not mean, understanding the relationship between risk and return does not mean that risk should be intentionally sought or intentionally avoided. I'm not saying that at all. Okay? You do not seek risk just for the thrill of seeking risk. Risk aversion means that you should be on the lookout for risk when an investment promises a high rate of return. Okay? It means that in order to take on risk, you get paid for it. Risk should not be avoided, because when risk is managed in a prudent way, okay, then including risky assets in a portfolio is appropriate and desirable because it can increase your return, should increase your return. That's why you're taking the risk, to increase your return. And if you blend the right assets together, and we're going to look at this in a later chapter, hopefully you can increase your return and actually decrease your volatility. And that is the best world to be in. All right, so we're going to stop there, and on the next clip, we will go from slides 50 to 59, and we'll start looking at computing returns. Until then, I bid you a fond farewell. Peace out. Shalom.